All right. Thank you all so much for joining us today. We're going to go ahead and get started. Welcome to our 2025 kickoff event. I'm your host, Jake Alexander, here with my good friend, Adam Taylor from Taylor Financial. Thank you all for taking some time out of your day to join us today. Thank you so much for working with us with our little scheduling change that we had last week, too. It means a lot that you take a little bit of time out of your day and come spend some time to talk with us about things that we love most, which is finances and taxes, stuff that we find invigorating. And so it means a lot that you all do too. We're going to go ahead and get started here. Just a little bit of overview of what we got in store for you. We always start with a little bit of an intro, just a little bit about your hosts. Once again, I'm Jake Alexander from Action Accounting, here with Adam Taylor from Taylor Financial. So just quick introductions on us. Then we're going to jump right into the heart of everything. We're going to talk about some finance stuff with Mr. Adam Taylor over here, a little bit about what to expect, some market updates, and some changes that are coming down the pipe in 2025. From there, we'll go into tax preparedness. That'll be with me. We'll talk about a little bit of the basics of some of the things we'll need from you to get started on tax prep for 2024. Then we'll cover the individual side and the business side. And then, of course, last but certainly not least, we always leave time at the end for Q&A with these. With that being said, we do like to interact with you as much as possible throughout the course of the event as well. If you notice, the little option bar at the bottom probably looks a little bit different from what you're used to from regular Zoom meetings. This is the webinar version of Zoom, which means the chat. If you go to try to type in the chat, it'll say it's disabled. You got to use the Q&A box. And so sometimes if you look at the little box down on the bottom, sometimes it's right next to the chat. Sometimes it's got to get a little fancy. You got to go over to that little more button where it has the little 3 buttons. And then there should be an option for Q&A there too. So I always advise people, type in your first name, type in where you're joining us from, just so we know, A, that you can use the Q&A box, but we want to encourage you to use it as much as possible throughout the presentation too. So if you have a sec, just so we know everything's working properly, go down there, type in your first name, type in the city that you're joining us from, so we know everyone's out there. We know everyone knows how to use that too, because we do want to hear your questions throughout the course of the presentation, and then especially at the end as well. So from here, we'll jump right into it. Quick introduction on me. I'm Jake Alexander. Action Accounting is the name of our company. I've been around since 2016. At this point, we have 4 main departments. We have our bookkeeping department, which is in charge of creating financial statements for business owners, and most importantly, actually teaching business owners how to read those financial statements so they can start making informed decisions on their business, understanding how much money is coming in, how much money is going out on a regular basis, and looking at those statements on a regular basis. That's our bookkeeping department. Then we have our tax preparation department. These folks are very popular around this time of year, so we're getting ramped up here. We're getting everything started and ready for 2024 tax season to file all those business returns and individual returns for all the owners of businesses. Then we have our tax planning department, which now is the best time for 2025 to get prepared for tax planning. So the best time to start is always as soon as possible. It's all about being proactive instead of reactive. And then last but certainly not least, we have our business consulting department, which is the latest addition to our services at Action Accounting. And so there we help business owners turn their business into an actual business by putting systems and processes in place so they can build a business that can operate without them on a regular basis moving forward. And so if you ever need anything from us, you can always reach us at our website, which is actionaccountingusa.com. And then, of course, you can follow us on all the fancy social media channels too. And that's a little bit about me. I'm going to introduce my friend here, Adam Taylor, who's CEO of Taylor Financial. And this is interesting stuff here. You're actually a sommelier. I can never say that word right. You could probably help me say it the right way, but a wine expert turned business owner. You were the youngest managing partner ever with the Capital Grill. You started Taylor Financial in 2018 all by yourself. At this point, you've won the Seminole 100 fastest growing businesses owned by FSU alumni 6 times, which is amazing. Nominated for Small Business of the Year finalist by Tampa Bay Chamber for the past 4 years, and you're truly a student of the business. This is pretty interesting right here. You actually have more letters behind your name than what's in your actual name together. Is that right, Adam?
That's true. That's unfortunately, but fortunately, I guess true.
I love that. And that means you really know your stuff. And I know you got some great information to share with us here today. So I'm going to turn it over to you. I'm going to stop sharing my screen and I'm going to let you take over and then take us from here. So.
Sure. Yeah. So I've got a tremendous amount of just data and information. If you know anything about Taylor Financial, we don't make changes to one's portfolio or follow any trends that you may see on Squawk Box or online. We follow really data, and we look back for decades to centuries to see kind of what the predictability would be within a market. So the big question we have right now, especially with Trump taking office and a lot of these new executive orders that have happened, there's 7 to 10 of them that are pretty instrumental within the actual equity market. But the big question is, we're coming off the 2 best S&P 500 years since the early 90s, right? So we had 24% growth last year in 2024 and about 25% in 2023. So what does 2025 look like? So that's where probably the main question a lot of our clients have. Should we stick with stocks? Should we look at bonds? Should we look at international exposure? So there's all these different questions. So instead of just saying, here's exactly what you should do, I want to go over some slides that I do have prepared for a speech tomorrow that I'm talking to 300 top realtors in Tampa for Berkshire Hathaway. And so it's a lot of data, right? So I know we only have a short amount of time today, so I won't go through all like 67 slides, but I do think there's some valuable stuff there that I'll touch on for sure. And I want this to be interactive as well, so I can see the Q&A. So I know Ron will probably have questions, and maybe Yvonne will have questions. But if you do have questions, just shoot them up on the screen. I'll do my best to answer those along the way. So let me see, presenter view. Share my screen.
Yeah, you should have access there. You should be able to pull that right up.
Okay, so there's the lovely slide. Thank you, Jake, for that. And let me get to the next slide. So Taylor Financial, we've got 13 team members, 6 advisors. We have 1,000 plus clients in 24 different states. So we're a full financial planning firm. So we help clients with the risk management side. So could it be anything from the estate planning of having a will or trust done? Chase here in the office can help a lot of our clients with that, to risk management of life insurance, disability income, or even long-term care. Majority of what we do is the wealth management, which is the fiduciary investments that we do for clients. That could be an IRA, a 401k, a non-retirement account, whether it's accumulation or the decumulation phase of one's plan. We do that quite a bit. We use some really unique software for some actual planning of what does that income look like now and decades down the road. And then, of course, we look at just the overall portfolio analysis. A lot of clients come to us with an already having an advisor, or if they didn't, they're not really sure if they're invested the right way, and then how long their money may last. So I'll skip this, but there's a lot of stuff that we do. We've been in business since 2018, independent-wise, but I've been in the industry for 15 years now. So I did this presentation close to Christmas. So one of my favorite movies is The Christmas Carol. So it's a little cheesy, but we're gonna like Ebenezer Scrooge. We're gonna go and visit the ghost of our financial past. We'll talk about where we are present, and then I'll give you some crystal ball of where I think we're going in the future. So let's talk about stock market, taxes, Fed rates, inflation, unemployment. These are all pivotal characteristics and areas that can really affect your plan. So, and if we look at the S&P 500 going back to 1990, we've had a lot of bullish years where we've seen positive returns year over year. You can see those horrible 3 years back in the 2000s for the .com, and that was rough. And then the global financial crisis in 2008, and then in 2022. You can see where inflation was 9+%. I think that June or July of 2022, and it really affected the equity market quite a bit. But as you see, 23 and 24, the best 2 years in a row going back to the 90s. So back-to-back 20+% gains. What does that look like for 2025? So market timing is key to high returns. Many believe timing is key, but missing just a few top performing days significantly impacts long-term rates and just overall growth. So if we look at going back to essentially January 1st of 2000 to the end of last year, If you put $100,000, let's say, in the S&P 500 total return growth portfolio, the average rate of return going from 2000 was a little over 7.5%. Now, granted, we picked those days because, as you saw previously, .com was right there at 2000, 2001, 2002. So you're off to this awful start, as you can see from the decline of the line graph. But long term, it was solid and it was positive. But the annualized returns, if you didn't miss one day, you got a 7.7% return. If you missed 10 of the best days, your return was almost cut in half. If you missed 20, 30, 40, or 50 of the best days of the 25 years going back, your returns were significantly different. So a lot of our clients say, hey, is now the right time to get into the market? The market's too high, the market's too low, it's not the right time. Well, there's always a time to buy and always a time to sell. And what we tell clients is, hey, the market is cyclical. It's going to go up, down, sideways, and in circles, and we can't time the market, right? So back in 95, in 2005, everyone said, the market is too high. You could even say that now. Price per earnings are too high. We've had 2 years with 20+% S&P 500. It's too high right now. We shouldn't invest. But the reality is, going back for decades and decades, that's just not the case. So now is the wrong time to invest. Well, timing the market really risks a lot of your long-term gains. Holding cash is better than investing. Holding cash may feel good, but inflation erodes its purchasing power quite a bit. So if you look at the CPI index change going back to the early 90s, we see about 2.5%, right? But the Charles Schwab value average money fund investor return is 2.5%. So barely keeping up with inflation. And if you sit on just cash, maybe it's not even a money market, you're really leaving and losing a lot of purchasing power in that overall position. So we advise clients to have 3 months of pure expenses set aside if there's only maybe one income in the household. If there's 2 incomes in the household, maybe there's less, but having 3 to 6 months on average of pure expenses in cash is great. Anything above that, we do want to assign a job. So more people nowadays are sitting on cash than they were even 5 years ago. So we're constantly looking at that as a part of their plan to make sure they're just not sitting on too much cash, because we know that that could be harmful long term. So investing in growth assets far outpaces cash savings in the long term. So this goes back to the early 90s, investing $100,000. And then if we look at staying invested, the S&P 500, going back to the early 90s, has generated a return over 10.5%. So think about that, Jake. That one-time $100,000 investment would be worth $2.7 million today. But having hopefully that advocate, having that behavioral, having that trust in the market, knowing that when that 2002 happens, knowing when global financial crisis or even COVID, or having all these years that could be negative, like, let's just buy, hold, let's maintain, let's make sure that we have some cash or some other assets on somewhere else. But long term, S&P 500 by far has been the strongest index. You can look at Russell 2000, which is more of small to medium-sized companies, small and mid-cap, if you will. Gold, we get this all the time where people say, I should just invest in gold. Well, the data says that's not really the case. And same thing with obviously bonds. Short-term, long-term bonds are typically more of a hedging tool. Not been the case the last 5 years, which we'll get into. And then money market is great. You do have enhanced liquidity, but obviously you don't keep up with the purchasing power of a lot of it. So successful investors take big risks. So even a 60-40 benchmark, which is 60% stocks, 40% bonds, if you had an initial investment of $1,000 made in January of 2000, and you had what we would call dollar cost averaging of $250 a month with a 3% increase, let's say inflation, Total contribution would have been 110,000, but your portfolio would be over $300,000 in a very, very conservative portfolio. So again, we want to make sure that we're well diversified. That helps to weather the storms on some of these times. I'm going to skip through some of this just because we'll be here for a while. But let's talk about the present. So the present of 2024 results, NASDAQ, which is more of a tech-heavy indice, was up 30%. S&P 20%, Dow 13%. Dow is sometimes hard to gauge as it's only 30 stocks, more industrial for the most part. Bitcoin, this is a hot topic, right? Bitcoin up 124%. So I don't think we have time for me to go into my thought within Bitcoin and kind of the use of it. But hey, if it's a speculative investment you want to take advantage of, then you've had some really good returns recently. Meta, which is Facebook, was up 65%. Nvidia up 171%. Yesterday was a very challenging day with a new Chinese company called DeepSeek and really showcasing how AI can be pretty effective with not spending billions of dollars. Netflix took a hit of 17% yesterday alone, but it has rebounded a little bit today. So I think it's up 7-8%. Tesla up 63%. So there's been a lot of these magnificent 7 stocks, if you will, that are part of the S&P 500, which I'll show in a moment, that have really carried the actual growth of the S&P 500. So here are the top performing stocks of last year. Vistra, which is a utilities company, was up 258%. So a lot of people say, oh man, Bitcoin was by far the best investment. Well, the reality is there's a lot of these large companies, even including United Airlines, which was up 135% last year alone. Now, if you Google JetBlue today, maybe not so much. They're having a very challenging day, but you can see a lot of these companies had some really big wins last year. And it's because their price for earnings were doing extremely well. And I'll talk more about with the new administration and some of the executive orders and what I think will happen with a lot of these large US mega cap companies. But you can see there are some really strong performance numbers from these companies. Okay, so yet to come. So crystal ball's coming out here. So let's talk about, you like this? My stock market, Jake? This is like my crystal ball, right? This is, I'm channeling my inner gypsy or my inner psychic ability.
It's beautiful.
Okay, so this is probably yeah, I'll digress there. This is probably one of the biggest questions we've had the last week. So January 20th, Trump, even as of yesterday too, I'm sure of today, he is executing a lot of executive orders. And so the question is, how could that ultimately affect the financial markets and my portfolio? So I'm going to touch on the top 7 that I think are probably the most valuable to look at. And then how do I think that's going to impact the future of 2025 and what does that look like from the potential equity market? So the first one is putting America first in international environment agreements. So the directive emphasized the prioritizing domestic economic interests, energy independence, and national sovereignty. So with a renewed focus on domestic energy independence, we personally within Taylor Financial, we're looking at ExxonMobil and Chevron because we think they will have some opportunities with their growth and with a lot of enhanced sales. They're strong dividend stocks as well. So these are some companies that are more on our radar than ever because of that more domestic focus. America First trade policy addresses trade deficits, currency manipulation, and unfair trade practices. This was his second big one that he signed. Again, more domestic production means industrial sector will benefit greatly. So when we think of that, the industrials, as you saw on some of those top stocks from 2024, we think that when we get into tariffs, when we talk about that the ultimate goal of tariffs is to bring back manufacturing to the US. And where we think that's going to have an increase in potential equity market, would be that industrial sector. So that executive order alone is shifting gears a little bit to some of the sectors that we're going to invest in for 2025. Promoting energy independence. This goes on with number one as well, but expanding oil and gas exploration in Alaska to try to have just more of that domestic exposure. The development of Alaskan oil and gas resources could provide significant opportunities for companies involved in exploration, production, and infrastructure. So going back to oil and gas, going back to industrials, we do think that we're going to see a lot of new companies pop up, a lot of subsidiaries of some of these large mega cap companies, and again, more emphasis on U.S. equities. I know it's a lot, but we'll get through it, I promise. The National Emergency Declaration at the southern border. So this measure strengthens border security with more staff, technology, and infrastructure to tackle immigration, drugs, and security threats. So what does that do? So that talks about the focus of border security is expected to drive demand for defense and surveillance technology. So as I'm sure a lot of you know, we still do a lot with government and defense contractors as clients. So we're starting to see even their business have some really positive momentum with what's to come there too. I will talk about with the enhanced border security, there's certain industries to where workers may not be readily available as they once were, which is something that's interesting in one of these slides here. So that may be something to where we're not as bullish, maybe in the landscape industry as we are in the cybersecurity industry. Executive order targeting TikTok and other foreign controlled applications. This move is part of a broader effort to safeguard national security and protect user data from foreign adversaries. The U.S. technology sector could benefit from this. So if they're going to move away from TikTok, you may see some advertisers, you may see some users move to some other applications. Facebook, Snap, who knows? There may be a new one that pops up, or it may be to the point to where, hey, some US company buys TikTok, and then again, we have some more control. But I think this is going to put more emphasis on the data security companies. So that touches a little bit more on the tech sector as well as a surveillance technology company. So something that we're very, very mindful of. Initial rescissions to harmful executive orders and actions. So if you read deep into this on the White House page, goodness, there is, I feel like, hundreds of executive orders that were rescinded from the Biden era. And a lot of these focus on COVID-19 pandemic, the use of D&I, climate immigration policies. So it's just a tremendous amount of them. And so what does that mean? That means the dereg of these policies aimed at reducing compliance burdens may create favorable conditions for financial services and manufacturer companies. So driving investments and innovation to that. So if you look at the JP Morgans, the Bank of America, if you look at some of these banking sectors that don't have to potentially go off of DEI, that don't have to go off of certain regulations, that could enhance their innovation, that could enhance their cash flow. So we're really bullish within the financial services and the banking sector too. Okay, withdrawal from the OECD global tax deal. The decision reflects administrative to focus on domestic economic priorities and maintaining competitive tax advantages for US-based companies. So the withdrawal allows US corporations to retain a more favorable environment compared to global peers. So what that means is some of these large, what we would call mega cap companies, will probably going to have their best year ever. So a lot of that's S&P 500 driven. A lot of that could be, as you saw from the previous screen, certain sector driven. There you go. So the Apple, the Microsoft, the Nvidia, Amazon, etc. Okay, I'm going to stop pretty soon because I know we're going to a lot and I can go for another 30 minutes because I just geek out over this, but let's look at history. So if we go back to 1928, so if you look at 100 years almost of election data, so the S&P index total returns, first year of a 4-year president term, you can see that on average, the S&P 500 the year after election has done very, very well. Actually higher if a Democrat got in versus a Republican. But in general, we usually see a very positive year the first full year after election. So again, just data going back to 1928. So regardless if the House and Senate, if full Congress control versus Republican or whatever party, that doesn't really matter, and at least it doesn't from a data standpoint. So there's one time back in 2021, which is the dot-com era, where we saw pretty much across the board every sector being down, technology down 25+% that year. But for the most part, again, the year after a full election, regardless if the Senate and House are split or controlled by one party, doesn't have a tremendous amount of effect on the overall growth of the market itself. Okay, so I'm going to stop there, Jake, because man, I'm getting too excited here. So I'll stop. I can go longer if you want. I'm sure there's some questions that will pop up. This is part of a much larger presentation where I'm presenting for 15 minutes tomorrow. So I have that like almost Micro Machine guy commercial where he just talks very quickly and just tries to get everything in one time.
I love it. You can tell you're passionate about that stuff, and that's why you're so great at what you do. If anybody has any questions, I know a few more people jumped in. Feel free to pop them in the Q&A box. If you try to use the chat, it's going to tell you it's disabled. That's not because we don't want to talk with you. It's just because you have to use the Q&A box. While they're doing that, I would say I'll go ahead and pop up the tax stuff so we can cover that, Adam, and then we'll blow through it. I'll try to do the Micro Machines guy voice as well as you did and go through it pretty quick, so we can make sure we got time for Q&A at the end. So let me bring that up and we'll go from there and get everything going. So if I can figure this out without crashing the whole presentation, which is ideal, then we should be good. So you can see that on my screen there. Perfect. So the basics. Once again, thanks, Adam. I'm going to go into a little bit of the basics. So here we are. 2024 tax season is officially up and running. What we like to do with our clients is just make sure we have everything understood and everyone's as proactive as possible. So we would ask you to get onboarded now. We do that through our support team, which is basically our customer service team. They're in charge of setting up your client portal, which is where you'll upload all of your documentation. Throughout the course of getting those taxes prepared and ready, we ask clients not to email us stuff because it's not secure. We highly, highly encourage you to use that client portal as much as possible. And the whole goal here really is just to have a good understanding of all of the dynamics that are going to go into your tax return for this year. So we want you to get organized now. If you're an employee, then you should have a W-2 coming in the mail. If you haven't got it already, it should be coming any day now. Legally, those are supposed to be sent out by the end of January. Every once in a while, people are a little bit behind, but those should be coming any day now if they haven't already come. For contractors, you should be getting 1099s. If you have a business, we need to understand your income or losses that you had for the year. So we're going to ask you for a P&L and a balance sheet. Hopefully you have those because you're using some sort of accounting software like QuickBooks or a fancy spreadsheet or something to that nature. If you're not, we have a business expense form that we provide to our clients that some of you are probably familiar with. From there, if you had investment income, so those are going to be more 1099s coming in the mailbox or getting emails that the electric statements are ready to download now. If you had rental property, this one, if you manage them yourselves, you should have pretty good records of all the income and all the expenses for the year. Or if you use a property manager, a lot of times they'll send you a 1099 and then an expense statement there as well. If you own your property, you should have a mortgage interest and real estate taxes statement. That's a 1098. These are just some of the documents you can expect to be coming in your mailbox here real soon. So get all those together. If you had any major life changes, this is something we need to know about. So if you got married or if you got divorced, or if you had a child, or you're no longer responsible for taking care of a child that you were in previous years, these are the kinds of things that we need to know about. And so we want to wrap our head around everything so we have a real good understanding of all the dynamics that are going to go into your taxes for this year. And so From there, we talk about preparation. Are you an extension or an early filer? We love all of our clients, right? And we're very accommodating as much as possible. But we like to know is, are you the type of person who's ready to get started on this stuff now? Like, do you already have a folder on your computer or that manual file down in the filing cabinet with 90% of the stuff ready to go? Or are you an extension filer? Do you like to file an extension and wait till the last possible second to get those taxes filed because you don't want to give the IRS 1 penny of your money earlier than you have to? So we just need to know either way. The deadlines for business returns, so S corporations and partnerships, is March 15th. The deadline for individuals, C corporations and nonprofits, is April 15th. If we do file an extension, that gives you an extension of time to file your tax return, not necessarily an extension of time to pay the taxes owed. That's always an interesting conversation that we have with clients pretty much every year. But if you do want to file an extension, that gives you till September 15th on the business and October 15th for the individual. Once again, we want you to use that client portal as much as humanly possible. Once we get you in there, where there is an engagement letter that we ask our clients to sign, this just sets really clear expectations on both sides so everyone knows exactly what's going on. We have a questionnaire that's going to ask you some questions. This is all really important stuff relevant to us preparing the tax returns for you. So the more information we have, the better. So please do your best to fill out that questionnaire. And then we'll typically take a retainer up front. This is a smaller payment for us to get started with the tax preparation for the current year. And then we'll send you a bill for the difference when we are done with everything. And it really all comes down to communication. We thrive, or we pride ourselves on attempting to communicate with our clients as much as possible. We just ask for the same back in return. So let us know what's going on. Let us know if you want to file an extension, or if you're an early filer, there's commitment emails going out from our support team. This is basically asking you, hey, do you want to get started on those taxes now? Do you want to file an extension and us leave you alone till after the summertime later in the year? Either way is fine with us. It's all about communication. You just got to let us know what you prefer. And so you can always reach out to us at our support team email. So it's basically our customer service team right here. This inbox is managed by a team of people. So if you have a question, if you have a concern, if you need a copy of everything, if you have an emotional outburst, whatever it is, please send it to support@actionaccountingusa.com. That's a managed inbox. We'll make sure you get timely responses there. Okay. So switch gears a little bit, talk about the business side. If you own a business, we want to make sure you have clean books and records for 2024, right? Hopefully you're using some sort of accounting software like QuickBooks Online or some sort of fancy spreadsheet. At the very least, we want you to fill out one of our business expense forms. If you have a newer business that you started, then that's totally fine. A lot of our clients utilize those. We want to make sure if you are using QuickBooks Online that everything is categorized and reconciled. So we have this conversation with clients every year too. For whatever reason, if you're managing the books on your own, or you have someone who you know and trust to manage them for you, you want to make sure that they're reconciled. Everyone usually gets the categorized part right. That's where you put it in the different categories, like, oh, this expense was for software, or this expense was for marketing or meals or whatever. Everyone's usually pretty good about that. But the reconcile, for whatever reason, a lot of people miss this. And reconcile just means double check. So we're double checking that all the numbers that show up in your QuickBooks Online account or whatever accounting software you're using actually reconcile to what's in your bank statement. And I could tell you some crazy horror stories about getting financial statements from clients where the revenue's literally off by like over $100,000, or the expenses are off by $30,000 or $50,000. So doing a reconciliation is going to help you avoid that and make sure everything is correct and everything is taken care of. If we manage your books for you, we would encourage you to schedule time with your bookkeeper to review and approve the financials before we send them to the tax team. So if you're one of our clients, you should have been getting monthly financial statements all throughout the course of 24. And you should be looking at those, right? I know a lot of things happen and sometimes we don't have the time to go in there on a monthly basis, but at least one time prior to the end of the year, we want you to look at those and double check everything just to make sure we don't need to make any adjustments or updates before we send them to the tax team. So you can do that on our side by sending an email to the support@actionaccountingusa.com email. They'll respond with a calendar link to get you booked an appointment with your bookkeeper so you can go through and review those and approve them prior to us getting to work on the tax returns themselves. Out-of-pocket expenses. This is another one a lot of clients seem to miss for whatever reason. If you got a new credit card throughout the course of the year, or if you had a personal credit card where you spent $30,000 or $50,000 in business expenses, but it's not tied to your QuickBooks Online account, we consider those out-of-pocket expenses. So we can still make sure you get credit for them. We just need to know about those so we can incorporate them properly. Another one is home office expenses. So this is one that typically will not be tracked through your QuickBooks Online account throughout the course of the year. A lot of times this is things like a percentage of your mortgage interest or real estate taxes, or a percentage of your rent, percentage of your utilities, internet, cell phone, those sort of things that necessarily aren't coming directly out of your business account. But if you qualify for the home office, we want to make sure you get credit for those too. So those are the things you'll have to let us know about and make sure we get everything in there nice and tidy for you. Retirement plans. So if you made a contribution to a retirement plan in 2024, or if you still plan to, because for a lot of these plans right here, the solo 401k, the SEP or the simple, we might have some time to still make a contribution in this year that would give you credit towards your 2024 taxes. And so those are just some things to get the mind working to make sure we have a good understanding of everything going on, and we're going to be as prepared as possible going into the tax season. So start now, don't wait until the last minute. This is one I always think it's really important to cover. For whatever reason, we get clients almost every year who just fully don't understand this until after the fact. But we say prior to us starting work on the tax returns, or prior to you signing off on the tax returns, we want you to understand the net profit of your business and what impact that could have on you in the future for credit approval purchases. So one of the benefits of being a business owner is you can write things off, right? For whatever reason, every year we do get clients who like to write a lot of things off, which is fine. That's one of the benefits of being a business owner. But you got to understand, if we're showing a tax return that has little to no net profit in your business because we chose to write everything off, therefore we're paying little to no income taxes, that could also negatively affect you for credit approval purposes going forward. So if you're trying to buy a house for personal reasons, the first thing they're going to ask you for is a copy of last year's tax return, last several years' tax returns. If you're trying to buy a building for your business, if you're trying to buy vehicles or fleet or any of that sort of stuff for your business, that's something that's going to play into it. So I like to make a pretty good point about that and make sure everybody understands. It's great. We recommend paying the least amount of taxes as possible, but you want to make sure you understand that net profit number and kind of what it's going to do for you long term. Any documents you have for major asset purchases throughout the year. So this is things like business equipment, vehicles, machinery or equipment for any type of warehouse or anything. If we plan to utilize Section 179 and depreciate some of that stuff, we're just going to need the purchase documents for it. So start getting that stuff together. This is one of the things, Section 179 is kind of a hot topic. For 2024, the amount was set at 60%. So if you purchased assets for your business in 2024 through Section 179, we could depreciate up to 60% of the total value. Now for 2025, it's set to go down to 40%. So this, and then it's actually on what's called a sunset period currently. So that in 2026 would be 20%. 2027, it's set to expire. This is also, it's not confirmed yet, but one of the rumors out there that this is one of the major changes that President Trump will make, which would be to reinstate Section 179 to 100%, which would be awesome because we have a lot of clients that utilize that strategy towards year end to lower their overall taxable income. And not to get too in the weeds here, but one of the reasons this one is so great is because depreciation on your tax return doesn't negatively affect you in a credit approval process with the net profit that I was describing earlier. So those are things to think about on the business side. We go on the individual side. These are all your employee benefits, right? So if you did things like harvest capital gains last year, which is where you offset gains with losses strategically in your portfolio, working with an amazing financial planner like Adam, I'm sure they would have taken care of that for you. You're going to get 1099s in the mail for those. Those are what we'll need to report that stuff there. If you did any charitable donations, just to make sure you have all the documentation necessary. We love taking for deductions for that kind of stuff, but we want to make sure that we have everything. So if that donation was under $250, we really just need the written acknowledgement form from the charity that you made the donation. If it's between $250 and $500, we need that written acknowledgement plus a description. So we need to know a little bit more information. If it's between $500 and $5,000, we need all that stuff. So we need the description, the written acknowledgement, and then we got to file a 8283 form on the tax return, which is going to ask a lot more detailed information, like the date you actually purchased, whatever it was that you donated, how you calculated the fair market value, and what that fair market value is. If the items you're taking deductions for is over 5,000, we actually need a written appraisal to go alongside with taking that deduction. And so if you did an HSA, which is a health savings account, and once again, too, these are a lot of employer benefits for the people who are employees out there, if these are the kind of items that if is offered by your employer, we would recommend taking as much advantage of them as possible. So if they offer an HSA and it makes sense for you and your family, if you're single, you can put up to $4,150 in there per year. If you're married and have a family, you can put up to $8,300. And so the cool thing about those is those funds will roll over. You don't have to utilize them all by the end of the year. And if you took place in that, you'll get a 1099 SA by the end of the year. Then there's SALT deductions, which is state and local tax deductions. A lot of people don't realize you can get deductions for state sales tax that you paid on consumer goods bought throughout the year. So if you had any major purchases like appliance in your household or a new personal vehicle that we're not writing off for business deductions, a lot of times we can calculate that in to help give you a little bit of an extra deduction on this state and local sales tax deduction category right there. Then there's also the real estate taxes that you pay on your primary residence, mortgage interest that you pay on your primary residence as well. You get a 1098 form for that. Then FSA, that's a flexible spending account, similar to an HSA, but a little bit different. Those you can put up to $3,200 per year. And if you did take advantage of that, it should be reflected in your W-2 that you get from your employer. And so that's a little bit about just for 24. We always like to talk about 25 and moving forward. And so for 24, there are still several items we could look at to make tweaks or recommendations or maybe depreciate something or make a retirement contribution. But the real magic in tax planning, in my opinion, is all about moving forward. And so for 2025, our recommendation is all about being proactive instead of reactive. You want to think about, and this is if you own a business, maybe think about incorporating the Augusta rule. That's where if you own a business and you own your home, your business can actually rent your home from you a certain amount of times throughout the course of the year. It's got to be for a bona fide business event. You have to charge in line with going market rates, and we have to have all the proper substantiating documents. But if you do, this can be a really good tax deduction for you right there. You could also hire your children. So this is another one. It's got to make sense. The children have to provide a role in service in the business. You have to pay them in line with going market rates. But if you do, in 2025, you actually pay them right about $15,000 per child per year that they work in the business. And then this income is a deduction from the business side, and then it's tax-free to the children if that's their only income. Then working with somebody like Adam and his team can show you some really creative things to do there to help start proactively building wealth for those children down the road. And so short-term rental, this is one that becomes more and more popular every year. We see a lot of business owners, a lot of W-2, higher earning W-2 employees as well, like this one, because you can buy a short-term rental. You can do what's called a cost segregation study on there, which is in a nutshell where we go in and individually pick out all the assets of the property that we can depreciate faster than the typical 39-year life that it usually gets. So this can be a really good strategy right there, if that makes sense. And then last but certainly not least, these will all heat up closer to Q4, so maybe a little bit later in the year, but we have these leveraged investments and leveraged donations with outside vendors that we work with where you can make an investment into their product or service or make a donation to their organization. And because of their status with the IRS, you get credit back for a much higher multiple than the money that's put towards those investments or towards those donations too. And so there's a little bit of the advanced strategies, and for stuff moving forward, I always like to end it with this right here. This is like one of my favorite quotes out there. It's by Judge Billings Learned Hand, who was a United States Court of Appeals judge back in almost 100 years ago. And still this today, this was an official court opinion that still to this day has not been overruled. And he said, anyone may so arrange his affairs so that his taxes shall be as low as possible. It's not bound to choose the pattern which best pays the treasury. There's not even a patriotic duty to increase one's taxes. And so say all that to say, this stuff is okay. It's good to have a tax plan. It's good to be proactive about it. Don't wait until the last minute. You know, obviously now is time to file our taxes for 2024. So we want to get started on that. But if you want to start planning for 2025 and you want to pay less than you have in previous years, we recommend booking a call with one of our expert advisors so we can go through it with you. You can do that from emailing support at actionaccountingusa.com. You can always call the number on the top of our website, or if you got questions, you can always pop them in the Q&A box here too. And so that is all I had to cover with everybody. If you do have questions, we recommend put them in the Q&A box. I always kind of jokingly say, if nobody has any questions, that means, Adam, that means we did such a good job at covering everything. Nobody could actually have any questions because we covered everything so concisely and correctly. So type those in real quick. I'm going to take a quick sip of water, and then we see somebody typed one in here. Yvonne said, thank you. Thank you, Yvonne. For salt. So since Hurricane Helene flooded me, can I deduct sales tax I paid on new furniture, appliances, and cabinets? Absolutely. So it all depends, right? It has to go into what's called the itemized deductions bucket. What I would, and that number has to be over the amount of the standard deduction for it to actually make a difference. But the answer is you may be able to. So if you have proof or if you have receipts or documentation for those items, I would recommend totaling those up and giving those to us if we're doing your taxes or whoever your tax preparer may be, and they'll be able to tell you if they'll make a difference for you or not. But if you, the simple answer is if you itemize your deductions, then yes, it could help you out. You can also, something I didn't cover here, but we did in a previous webinar, is any out-of-pocket expenses for Helene or the other storm, since they were both considered federal declared disaster areas. Any expenses you paid out of pocket over insurance proceeds, you could get a deduction for that as well. So just make sure you keep good records, give us all that information, and we'll walk you through that stuff. So Adam, I see you're back. Did I do a good job talking as fast as you, or faster, or a little bit slower?
Fantastic. Great job.
We covered a lot of information there, so I think that was good. Thanks to everyone who joined. If you have a question, please type it in there so we can answer them for you. We'll get those covered. Yvonne says, my first year with a lot of medical costs. How are these deductible? So great question. It kind of goes back to the last question where they can make a difference from an itemized deduction standpoint. So the thing with medical expenses, it has to be a pretty high amount. There's kind of a convoluted calculation of how we come to if it makes a difference or not. What we recommend to our clients is to total that stuff up and give us the numbers when you give us all the information, and we'll be able to tell you if it makes more sense to go that route or just take the standard deduction because it's higher. So it depends. It's for medical stuff, it's got to be a pretty good size amount, but it can if it's the right situation. So Adam, I've got a question for you real quick while we're waiting for other stuff to come in.
Please.
So you said, I think we've all kind of heard that story of what you said where, man, if I would have put $10,000 in Apple 50 years ago, it'd be worth 20 million or whatever. I can't remember the exact thing you said, but it was kind of, hey, if I put 100,000 in the S&P about 20 years ago, it'd be worth 2.7 million or whatever. You know, everyone's kind of heard some version of that story. You're just sort of crystal ball or recommendation of, you know, if someone has that amount of money, let's say $100,000 now, would you encourage them to invest it all in the S&P, or how would you kind of manage something like that, if that makes sense?
Yeah, I mean, the stereotypical answer is it depends, right? So if it's 60-year-old asking that question versus a 30-year-old, well, it's going to be a totally different answer. So depending on the risk tolerance, depending on the big picture plan, what do they have in savings? What do they have in equity of their home? What's their earning potential? Like there's a lot of variables there before I could recommend that. So I wouldn't necessarily say, hey, put it all in the S&P 500. Now, the S&P 500 is all U.S. equities too, and a lot of our diversified portfolios have international plays in it for developed or even emerging markets. And so I do think that there should be more diversification. It again depends on the risk tolerance, but the S&P 500 is typical. It's very predictable. But it would really depend. It would make sure they have the right risk management in place. Make sure we're taking advantage of certain retirement accounts, whether deductible 401ks or Roth assets. So it would really it would depend. But our goal is to encourage clients to try to save 20 to 30% of their income. And if they have a windfall where they have a certain lump sum they want to invest, well, then of course that could be sometimes easier to incorporate into their plan.
Nice. And so don't go investing all of it on your own into any one or multiple items. Get with somebody like you who can make an overall comprehensive plan of what's the best thing to do with this based on your age, based on your goals, all those sorts of things is kind of what I'm hearing.
Yeah, if you want guidance along the way, if you want to coach, if you want to advocate, if you want someone to bounce ideas off of, I think it's imperative to have not only a plan in place, but a team or an individual that you can turn to that you trust that's an advocate for you and say, knowing everything I know and knowing what I know of you, here's what you should do versus just equate Google, what should I do with $100,000? Or what's the top stock that performed last year? I'm gonna put all my money into that, right? So that doesn't really turn out the best. So yeah, I would seek professional guidance.
I love it. I love it. Thank you, Yvonne. She said thanks. Asked about her medical deductions, keeping a list. That's great. That's what we recommend, Yvonne. If you need help with that, let me know. We've got some good templates for that kind of stuff. Sam asked, I see the action portals not providing 2024 files. Will that be updated? Yes, Sam, it will. We're going through in somewhat of a phased approach right now and launching that for all the clients. If you're ready, which is amazing, I'll write your name down and give it to the support team, and I'll have them reach out after this to get that moving. So thank you for that. Thank you, Sam. Then Janice said, I'm assuming this is for you, Adam. Do you have a minimum size percentage for clients? Do you have like a minimum client that you prefer to work with or anything like that?
I mean, we have numerous advisors on the team. So to get into what we would call a fiduciary or an advisory relationship, the minimum is $5,000. You may not work with me directly on an ongoing basis, but again, there's numerous advisors part of the team that can help lead you into the plan, lead you into the same recommendation that we would all give. So, so yes, there's a minimum. It's a very, very small minimum to get into the family of Taylor Financial.
That's great. You guys have a great team here. I can speak to that from personal experience. So yeah, I'd recommend. How does someone get a hold of you? What's the best way if this is from Janice here, but yeah, if you wanted to schedule an appointment with Adam or somebody on his team, where would they do that, Mr. Taylor?
Yeah, so taylorfinancial.com. We try to make it as easy as possible to book an appointment. So if you go to taylorfinancial.com, book an appointment, new client, it'll ask you a few questions just to make sure we put you in front of the right person. And that would be the easiest way. So you can easily book online. I mean, if you Google Taylor Financial, you'll see a bunch of stuff.
All kinds of great stuff, right?
Hopefully.
That's great. So Janice, I'll type this back to you actually too. You could go right there to the website to book an appointment, taylorfinancial.com, Adam?
Yes, sir.
Yeah, if you go there, we'd love to talk to you. If you have any questions from us, you can always go to our website, which is actionaccountingusa.com, or you can call the number on the top right. I'm excited. I feel like 2025 is going to be a great year. You know, 25 to me was really kind of foundational and building for us a lot of systems and processes, which are now we're excited to kind of let things rip. So I don't know about you, Adam, or if you have any final thoughts. It looks like we've answered all the questions. If anybody else has any questions, please feel free to type them in there and we'll answer those. I can turn it back over to you for a minute, Adam, if you got anything. And if not, we can let these fine folks go on about their day. So.
Yeah, no, I think that was great. There's a lot of data that I was talking about, and it's only a third, if not a fourth of the presentation. So if you're interested in learning more of kind of the mindset, excuse me, of the firm and kind of where we see 2025 going, book some time with us. I'm more than happy to go deeper into those conversations.
I see there too some decorations in the background of your office. You had a birthday the other day too, huh? Was that
I
yesterday?
did, yeah. So birthday was on Saturday, and they put up this little streamer walkthrough. I think I'm gonna keep this up for a while. I like walking through it. It makes me feel pretty special. So yeah, it may be up there for a few weeks.
There you go. Nice. When I came in there, I felt very fancy earlier, so I know what you mean. It gives it a very nice feel in there. So
Lovely.
beautiful. Well, thank you guys so much. Adam, thank you. If anyone has any last minute questions, type them in there. We'll stick around for another minute or two, right to about that 2:30 mark. Once again, we appreciate you working with us on the schedule change for last week. Adam got pretty sick. I actually thought I was getting sick yesterday. I didn't. I think it was just allergies because our weather's changing so crazy here. But the good news is I think our massive Florida winter is pretty much over for the year. So it was about 1 week of 50-degree temperatures, and hopefully we're back to 70, 75 moving forward. So, but I think that's about it. No more questions are coming in. Adam will let you go. Everyone who joined, thank you so much. Everyone who's watching this recording afterwards, thank you so much. Feel free to reach out to me or anyone on Adam's team. We'll get you taken care of, and we'll talk to y'all soon. Thanks. All right, see you, Adam.
Bye. See you.